How to wisely invest as a wealthy person versus someone who is poor. Have you ever wondered what sets apart a wealthy investor from a poor investor? And how their investing approach and strategies may differ? Well, in this video, we're going to look at how the two approach investing and what sets them apart. But before we get into the video, do me a huge favor and click on the like button because it really helps with the YouTube algorithm. So, the wealthy have a net worth that consists of shares in public and private companies, real estate, and personal investments, like art, cars, and planes. The secret doesn't only lie in their investment strategies, but also in their understanding of the basics of having money work for you. A concept that poor people unfortunately don't know. The wealthy also know how and when to take calculated risks and when to walk away. But we'll talk more about these in detail later in the video. So let's delve into how to invest wisely as a wealthy person versus an average person. 1. Investing in emerging markets. The perception is that developed countries like the United States and those in the European Union offer the greatest investment return and security. As a result, you'll find that the majority of people invest in already developed countries. While there's nothing wrong with this, the greatest opportunities lie beyond the borders, and that's precisely where the wealthy look for high-yielding opportunities. Some top countries that the wealthy are currently investing in are Chile, Singapore, and Indonesia. As an investor, it's important to do your research on these emerging markets, just as the ultra-wealthy investors do. When doing your research, make important decisions on whether these markets fit your investment portfolios and your comprehensive investment strategies. Emerging markets are risky, but remember, the higher the risk, the higher the returns. 2. Not investing only in tangible assets. The first thing people think about when it comes to investing and investing strategies is bonds and stocks. These type of investments are good, but you need to have a foolproof portfolio of different investments, and not a portfolio that only has these assets. The wealthy and the ultra-wealthy investors understand one thing. They know the value and risks that come with owning non-liquid assets. Thus, they carefully ensure proper legal frameworks and allocation of their finances accordingly. You'll find them investing in assets like private and commercial real estate, gold, artwork, and land. And in their portfolios, real estate is a favorite asset class. Owning different assets balances the volatility of stocks. It's important to invest in physical assets, but small investors shy away due to a lack of liquidity and higher investment price point, which is understandable. But when you see wealthy people wisely investing in these physical assets, then maybe you should be as well. In any investment portfolio, the wealthy and ultra-wealthy own illiquid assets, some of which could be uncorrelated with the market, but happen to be useful in their investment portfolio. The good thing is that these assets aren't susceptible to drastic market changes, and when you look at them long-term, they do pay off. Let me give an example. Between June 2006 and June 2016, Yale's endowment fund implemented a strategy which included uncorrelated physical assets, and they returned an average of 8.1% per year between those periods. 3. Investing in both public and private markets. Wealthy people and ultra-wealthy investors understand that substantial wealth is generated from the private markets, as opposed to common or public markets. Wealthy investors will gain a huge amount of their wealth from private businesses, through business ownership, or being an angel investor via private equity. Top endowments like those run at Stanford and Yale use private equity investments to generate high returns. It also adds to fund diversification. It's all about taking calculated risks. Both public and private investment markets have their risks and their benefits. But this is what wealthy investors do differently from low net worth investors. They take the risk, and it pays off, and usually very well. It's important to do your research, so you don't lose your money when the business's growth isn't as expected. 4. Saving strategy in your financial plan. Investing is a necessary step to become wealthy. As you begin this journey, don't forget the importance of having a saving strategy. Wealthy investors are wise in understanding a financial plan as a dual strategy. This means they are investing and saving wisely. This results in the wealthy investors focusing their time and energy on increasing their inflow of cash and minimizing their cash outflows, hence increased comprehensive wealth. It would be hard to think that wealthy investors are good savers, considering they live in wealth. but they know living below their means will make them achieve their desired level of wealth in the shortest amount of time. Unfortunately, this isn't seen in other low net worth investors or someone poor. Sometimes poor people poorly spend more than they earn, thus ruining their saving strategies. This in turn affects their investment goals and strategies, when overspending can easily be avoided to reach your goals. 5. Tax-conscious investments. A study conducted by the United States Trust revealed that more than half of wealthy investors agree that investment decisions that factor in tax implications are better than those pursuing higher returns, regardless of the tax implications. At the end of the day, what counts is the net pay, and that's how much you're actually getting after taxes. Besides, no one wants their money tangled up in tax problems. Poor tax management on your investment can result to losing as much as 40% of your gains every year. A wise investor will make sure that doesn't happen. When getting into investing and investment options, research the tax implications on the investment product you're in. Make sure your returns are safe and won't be minimized by poor management. For example, investors can invest their retirement savings in tax advance plans, like in a 401k, Roth IRA, or put their money in a flexible spending account. When you're informed on investing and financial management, you'll be looking out for poor tax management and implications on your investment. 6. Long-term investments. Big gains can be created by having a long-term buy and hold strategy. Wealthy investors have said that they make some of their biggest investment gains through this strategy. This strategy is about buying an investment and holding on to them for many years. These wealthy investors did this with traditional stocks and bonds, and they preferred it. Warren Buffett has also tried and advocated for the same. In a recent interview on CNBC's show On the Money, Buffett said that investors shouldn't be worried about the severe fluctuations in the market and shouldn't watch the market closely, since money is made in investments by investing and through owning good companies for a long period of time. If an investor is buying stock from a good company, they shouldn't worry because their investments will be doing fine even 30 years from now. This is one strategy to use, especially when you're young. Use compounding to your advantage, and by the time you're retiring, you'll have a comfortable pile of money to live off. 7. Strategic use of credit. In a study conducted by the U.S. Trust, they found out that 2 out of 3 wealthy and ultra-wealthy investors considered that credit was a decent way to build wealth. Additionally, 4 out of 5 wealthy investors know how to and when to use credit to their financial advantage. First, this strategy has a lot of risks. Credit is costly. However, savvy individuals can make this work. Let's see how. For those that pay their credit card balance in full every month, they can use the reward card and earn cash or perks for spending that they already do. Also, instead of rushing to pay off student loans or mortgages, which I'll assume are low-rate fixed loans, you can pay the debts on a schedule and use the extra cash to increase your retirement funds. In all these cases, you're using the money lent to you by the government or bank to fund your retirement as you pay for the loans through time. This can be done to fund your businesses or money-making ventures that will help you start accumulating wealth. 8. Keeping up with trends in your peers. A lot of people try to mimic and copy the actions of their peers, and they tend to waste a lot of time trying to beat them in their strategies. However, not getting caught up in this ridiculous competition is crucial and will help in the process of building personal wealth. What wealthy people do is a bit different. They're aware of the competition, so they establish personal investment goals and long-term investment strategies before they make any investment decisions. Wealthy people have a vision of what they want to achieve and where they want to be in a decade or 2 decades and beyond. They stick to their investment strategies as they know they'll get there eventually. Rather than chasing the competition or being scared of the imminent economic downturns, they stay the course. 9. Rebalancing your portfolio. Financial literacy is a big problem in the world. Though not taught in school, everyone has to teach themselves the basics and eventually be financially literate. This is especially important for investing. Everyone has to understand and practice rebalancing their portfolios. When you rebalance your portfolio consistently, as an investor, you ensure that your portfolio becomes adequate, diversified, and proportionally allocated. What's a balanced portfolio? A balanced portfolio includes the right mix of cash, stocks, and bonds, based on the person's risk tolerance and age. Wealthy people and the ultra-wealthy investors see rebalancing as a necessity. They may rebalance their portfolios either weekly, monthly, or yearly. They rebalance their portfolios regularly without fail. Those without time to rebalance their portfolios pay someone skilled to do it. They can set a rebalancing criterion with an investment firm based on the asset prices. This is one key strategy everyone should strive to have. When you're in control of your investment, you'll surely see it grow. 10. Delay gratification. Instant gratification isn't a need, and therefore it is and should be avoided. Wealthy and ultra-wealthy investors know that long-term goals are way more necessary than gratifying for your current needs or wants. If you truly want to build wealth, it boils down to one thing, and that's developing a character of delaying gratification. Spending first and saving later will leave you with nothing to save. Strive to save first and spend afterwards. At least then you'll have something left over. Let's say you put $100 every month towards your retirement instead of spending the money on something you want but don't need. After 20 years of saving with a 5% return rate, you would have accumulated approximately $40,000. However, if you would have spent that $100, you would have missed out on some big earnings years later. It's understandable that your current needs matter. Everyone's circumstances are different, and therefore, not everyone can do this. But get this, understand money, investing, and the difference between a needs and wants, and you will be on your way to accumulating wealth like the wealthy. Well, that's it for today's video. I hope you learned something. Give this video a thumbs up and subscribe if you haven't. Have a great day, you guys, and I'll see you all in the next one.